I didn't expect to say this out loud in my lifetime, but here we are. The Federal Reserve has effectively moved to cut Donald Trump's business empire out of the American banking system. Not fined, not sanctioned by a court, not convicted of financial crimes. Cut off. This wasn't a single bank quietly closing an account. This was a coordinated signal, delivered through regulatory pressure, that made Trump Organization entities radioactive to federally regulated banks. And then something even more shocking happened. Warren Buffett broke his silence. For decades, Buffett has stayed above political drama. He survived Watergate without commentary. He avoided impeachment scandals, financial crises, and partisan warfare, but this time he spoke, and when he did, Wall Street listened. Because this isn't just about Trump, this is about power over money and who controls access to the financial system itself. Let me explain what's actually happening beneath the headlines. Donald Trump's identity has always been inseparable from his businesses. Long before politics, the Trump Organization was the engine behind everything. His brand, his wealth, his leverage, his myth, hotels, golf courses, real estate towers, licensing deals. The business wasn't just an asset, it was the foundation of his public persona. For decades, banks worked with him. Some pulled away, others stayed. Deutsche Bank famously remained when most wouldn't. Regional lenders filled the gaps. The system functioned, until now. Because what's happening today isn't market choice. It's regulatory isolation. Over the last several weeks, federal banking regulators, acting in parallel, issued internal guidance that dramatically changed the risk calculus for any bank doing business with Trump-linked entities, not through criminal charges, not through formal enforcement actions, but through supervisory pressure. Banks were quietly told that maintaining Trump relationships would bring enhanced examinations, capital burdens, reputational flags, and regulatory headaches that no institution wants to fight. The message was unmistakable. You can keep Trump, or you can keep your peace with regulators. Most banks didn't hesitate. Accounts were closed, credit lines disappeared, merchant services began shutting down, even routine payment processing became uncertain. This is what debanking looks like. Not by law, but by pressure. Trump wasn't convicted of laundering money. He wasn't found guilty of banking fraud. No court ordered this. Yet his businesses were suddenly treated as if they were untouchable. And here's where the story turns dangerous, because the Federal Reserve isn't supposed to be political. It isn't supposed to decide who is economically acceptable. Its power rests on independence, on the idea that monetary and supervisory authority is separate from partisan conflict. That wall just cracked. According to internal reporting, regulators justified the move using vague language: heightened reputational risk, foreign exposure, compliance concerns. Terms flexible enough to mean almost anything, and powerful enough to mean everything. Banks were effectively told, if you want to keep Trump, you'll need to treat him like a sanctioned oligarch, enhance scrutiny on every transaction, every foreign customer, every wire transfer. Compliance burdens so extreme they destroy profitability by design. At first, Jerome Powell resisted. The Fed chair understands institutional credibility. He knows what happens when central banks lose neutrality, but pressure built. Trump's polling surged. His attacks on the Fed intensified. He openly threatened to strip the Fed of independence if re-elected. At that moment, the conflict stopped being abstract. From Powell's perspective, Trump wasn't just a controversial client. He was a political threat to the institution itself. And once that line was crossed, restraint vanished. What followed was unprecedented, a regulatory squeeze without charges, without hearings, without due process. That's when Trump fought back. His legal team filed an emergency lawsuit alleging constitutional violations, retaliation for political speech, selective enforcement, abuse of regulatory discretion, and something unexpected happened again. A judge stepped in. A temporary restraining order halted the coordinated pressure campaign. The court didn't rule that Trump was innocent. It ruled that regulators cannot quietly destroy businesses without legal authority. That distinction matters, because this case isn't about Trump's morality. It's about the mechanism. If regulators can informally make someone unbankable, without charges, without hearings, then financial access becomes a political privilege, not a right governed by law. And that's why Warren Buffett spoke, not to defend Trump, but to defend the system. In carefully measured words, Buffett warned that when banking regulation becomes a political weapon, capitalism itself is at risk. If access to money depends on political acceptability, markets stop being markets. Today it's Trump. Tomorrow it could be anyone. That warning landed like a thunderclap because it came from someone who has no incentive to lie, exaggerate, or posture. Now Congress is circling. Hearings are coming. Subpoenas loom. The Federal Reserve's independence, once sacred, is under its most serious scrutiny in decades. And Trump, as always, is turning the fight into fuel. To his supporters, this confirms everything they believe about the deep state. To his critics, it proves he's finally facing consequences. To the system itself, it poses a question no one wanted to answer. Who controls access to money, the law, or power? This story is far from over. If discovery reveals coordination between regulators and political actors, the crisis escalates. If courts allow informal debanking to stand, the precedent becomes permanent. And once that door is open, it never fully closes again. So watch this closely, not because it's about Trump, but because it's about what happens when financial infrastructure becomes a tool of political conflict. That changes everything. Here's the part most people miss. This wasn't a single decision. It was a cascade. In banking, you don't need a public ban to destroy someone financially. You just need enough pressure that no institution wants to be the last one standing next to the target. The moment regulators signal this client is a problem, every bank executive hears the same translation. If you keep them, you'll pay for it. And banks are built to avoid uncertainty. They'll take reputational pain over regulatory pain every time. So the closures started quietly. First, the low-hanging fruit. The accounts that are easy to cut, the services that aren't essential to the bank's revenue. Then the real damage began. Credit access. Trump's empire runs on leverage. That's not an insult. This is how commercial real estate works. Hotels refinance. Golf courses manage seasonal cash flow. Properties roll debt forward. Licensing deals rely on banking infrastructure to collect, distribute, and maintain a clean paper trail. You don't need to seize assets to collapse that model. You just stop the oxygen, and the oxygen is banking. Now, the public narrative coming from the regulators was predictable. Compliance, risk, anti-money laundering safeguards, suspicious activity. Foreign exposure. Those words sound technical, boring, and justified, which is exactly why they're so powerful. Because when someone says AML concerns, most people hear criminal, even if no charges exist. But inside the industry, it works differently. Banks don't need proof, they need plausible risk. And regulators don't need a courtroom win, they need leverage over bank behavior. That's why this felt less like law and more like coordination. If one agency says heightened risk, banks can still gamble. If two agencies echo it, the gamble becomes expensive. If three move in parallel, the message becomes policy without ever being written as one. And that's what made this unprecedented. Multiple regulators aligning their posture in a way that squeezed every bank into the same choice. Then came the domino no one expected: payment processing. People think banks are about loans, but modern business runs on merchant rails. If your hotel can't process cards, your luxury brand becomes a cash-only headache overnight. If your golf course can't settle transactions, you can't run events. If your vendors can't get paid through normal channels, you start losing them. That's when it stops being political noise and becomes operational collapse. And here's the part that made Trump's team panic. The closures weren't hitting one entity, they were spreading across a network. Because businesses like this don't operate as one company. They operate as a web. LLCs, subsidiaries, management entities, licensing vehicles. Cut the core accounts and everything connected to them starts failing compliance reviews too, like a disease moving through a system. Now I know what you're thinking. Maybe there really were suspicious transactions. Maybe. Trump's critics will argue this is accountability. They'll say, you can't spend decades in gray zones and expect the system to protect you forever. They'll point to past investigations, foreign payments, valuation disputes, civil judgments, and everything else that follows Trump like a shadow. But here's what matters more than Trump himself. If this can be done without formal charges, it can be done to anyone. And that's why Buffett's warning hit like it did. He wasn't saying Trump is innocent. He was saying the method is dangerous, because once regulators learn they can quietly make someone unbankable through informal pressure, without hearings, without transparency, without an appeal, then financial access becomes conditional on politics, optics, and power. That's not capitalism with rules. That's a permission system. And now the fight is shifting to the most explosive battlefield of all, discovery. Trump's lawsuit isn't just asking for relief, it's trying to open the box. Communications between agencies, emails, meetings, coordination with Treasury, any contact with the White House, because if there's proof that this was politically influenced, directly or indirectly, then this isn't just a banking story anymore. It becomes a constitutional story, and when that happens, every institution involved loses control of the narrative, because courts don't care about reputational risk. They care about authority. So the next phase will come down to one question. Did regulators act as neutral enforcers or as political actors using financial tools? And that question is going to decide whether this becomes a footnote or the moment America entered a new era where banking access is a weapon. This is where the situation stops being theoretical and starts becoming existential. Because once discovery enters the picture, the balance of power flips. Up until now, regulators held all the cards. They didn't need to explain themselves publicly. They didn't need to prove intent. All they had to do was signal risk, and the private sector would do the enforcement for them. Banks would comply out of fear. Silence would do the rest. But discovery changes that. Discovery forces names onto paper. It forces timelines. It forces explanations that can't hide behind vague phrases like heightened concern or supervisory discretion. And that's exactly why this case terrifies Washington far more than it does Trump. Because if a court orders disclosure, the questions become very specific, very uncomfortable, and very hard to answer without consequences. Who initiated the coordination? When did discussions begin? Were political considerations mentioned, directly or indirectly? Did regulators communicate with Treasury or White House officials? Were banks privately warned of consequences beyond formal rules? Those aren't rhetorical questions, they're evidentiary ones. And here's the uncomfortable truth for the regulatory state. Informal power leaves fingerprints, emails, calendar invites, phone logs. Just flagging this messages, risk memos that cite media narratives instead of statutes, language that hints at optics rather than violations. This is why Judge Cannon's involvement matters so much. Whatever you think of her, she is not inclined to defer to administrative agencies on faith alone. Her early language wasn't procedural, it was skeptical. She didn't say, let's wait and see. She said, in effect, independence does not override constitutional limits. That sentence alone sent shockwaves through regulatory circles, because the entire modern supervisory system relies on one assumption, that agencies can act first and justify later. If courts begin demanding justification before economic destruction, the system breaks. Now zoom out for a moment. This isn't really about Trump's hotels or golf courses anymore. It's about something much larger. Who controls access to the financial bloodstream of the country? In theory, banks do. In practice, regulators influence banks. And regulators answer, at least indirectly, to political power. That triangle has always existed. What's new is how openly it's being tested. Trump, for all his chaos, is uniquely positioned to push this fight to its limit. Not because he's morally pure, not because he's sympathetic, but because, 1, he has resources. 2, he has visibility. 3, he has nothing to lose institutionally. Most people who get quietly debanked don't fight. They can't afford to. They settle. They disappear. Trump escalates. And escalation forces clarity. That's why you're seeing panic not just in banking, but in commentary. Suddenly, people who despise Trump are saying things like, I don't like him, but this feels wrong. This sets a dangerous precedent. This power can be abused, because once the precedent exists, intent no longer matters. Today it's Trump, tomorrow it's a crypto exchange, next year it's a media platform, then a nonprofit, then an activist group. All it takes is a narrative of risk, and narratives are political by nature. Buffett understood that immediately. His warning wasn't emotional, it wasn't partisan, it was structural. He was essentially saying, if access to banking becomes contingent on political acceptability, capital markets stop being markets and start being instruments. That's a line America has never formally crossed. Now here's where this gets even more volatile. Congress is watching, not quietly. Subpoenas are already being drafted. Committees are lining up hearings. Not because they love Trump, but because this issue cuts straight through party lines. Republicans see a weapon that can be used against them. Some Democrats quietly see a weapon that could one day be turned inward. And banks? Banks are trapped, defy regulators and risk destruction. Comply and risk being named in court filings. There is no safe position. Which brings us to the next phase, one that could reshape everything. Will any bank break ranks? Because all it takes is one institution to say under oath, we were pressured, we were warned, we acted out of fear, not violations. If that happens, this story explodes beyond Trump, beyond the Fed, beyond this election cycle. It becomes a referendum on the administrative state itself, and once that door opens, it doesn't close easily. Here's the moment everything starts to crack. Not with a headline, not with a press conference, but with hesitation. Inside one mid-sized regional bank, one that had quietly maintained legacy Trump Organization accounts for years, compliance officers started pushing back. Not loudly, not publicly, just enough to slow things down. They asked a question regulators hate. Show us the violation, not the risk narrative, not the reputational concern, not the media context, the violation. And that's when the tone changed. Because there wasn't one, there were suspicions, there were flags, there were references to patterns and exposure, but no formal charge, no enforcement action, no finding that could survive cross-examination. What there was, according to people inside the process, were conversations that sounded less like regulation and more like warning. Stay exposed, expect scrutiny, expect scrutiny, expect cost, expect pain. The bank's lawyers started documenting everything. Calls, emails, meeting summaries, because banks understand something politicians often forget. If this ever reaches a courtroom, memory becomes liability. And then came the internal memo, short, carefully worded, devastating. It stated in essence that continuing the relationship posed regulatory risk disproportionate to any identifiable legal violation. That phrase matters because it admits the quiet truth everyone already knew. This wasn't about law breaking, it was about power. That memo is now part of a sealed evidentiary filing, and that's when the White House realized this was no longer controllable. You see, regulators are powerful when they act informally. They are far less powerful when they have to explain themselves formally. Once courts start asking why, the entire architecture of soft enforcement begins to collapse. And that's exactly why the pressure intensified. More banks exited, more accounts closed, more services vanished, not because regulators needed to win in court, but because they needed the reality on the ground to change before the law could catch up. That's the real race happening here. Trump's legal team knows it, the regulators know it, the banks feel it. It's a race between collapse and exposure. If Trump's business infrastructure collapses first, the case becomes moot. No accounts, no relationships, no damages to remedy. But if exposure comes first, if discovery reveals coordination, pressure, political motive, then the damage shifts from Trump's balance sheet to the legitimacy of the regulatory system itself. That's why this case matters far beyond Trump, because once courts rule that informal coordination can violate constitutional protections, the entire compliance culture of American banking changes overnight. Regulators would need paper trails, clear standards, formal actions, and power would slow down, which is exactly what bureaucracies fear most. Now zoom out again. This is happening at a moment when trust in institutions is already fragile, when people already suspect that rules apply differently depending on who you are and what you believe. And suddenly, the plumbing of the economy, the part nobody sees, nobody votes on, is being exposed as a potential political weapon. That's destabilizing, not emotionally, structurally. Because markets run on predictability, capital runs on neutrality, banking runs on rules that don't change based on who's winning the polls. Once those assumptions crack, uncertainty replaces confidence, and uncertainty is poison. This is why even people who despise Trump are uneasy, because this fight isn't about him winning. It's about whether anyone loses access to economic life without due process, and that question doesn't care who you voted for. The next phase will decide everything. Either a court forces transparency and limits informal regulatory power, or the precedent hardens and unbanking becomes an accepted tool. There is no middle ground, and whatever happens next will echo far longer than this election. This is the point where systems choose what they are willing to sacrifice, not rhetorically, not politically, structurally. Because every power structure eventually reaches a moment where preserving control costs more than revealing truth, or revealing truth costs more than preserving control. That moment is now. Behind closed doors, regulators are no longer debating whether this looks bad. They're debating how bad it could get if discovery keeps moving forward. Because here's the uncomfortable reality they can't escape. If courts rule that informal supervisory pressure, used collectively, strategically, and selectively, can violate constitutional protections, then decades of regulatory practice come under scrutiny, not just in this case, in all cases. Every suggestion, every off-the-record warning, every quiet nudge that led banks to cut off clients without formal action. That's not a single scandal, that's systemic exposure, and systems don't like exposure, so the pressure now is shifting away from Trump and inward, within agencies, between regulators and the White House. Because once subpoenas start landing, no one wants to be the person whose name appears first in an email thread that says, "We need to get ahead of this politically." That sentence alone would be catastrophic, not for Trump, for the entire administrative state. And this is where the irony becomes impossible to ignore. The same institutions that argue they must remain independent from politics are now fighting to avoid judicial scrutiny because that scrutiny might reveal political influence. That contradiction is the fault line. Now, Trump understands something many of his opponents underestimate. You don't need to win the case to win the war. You just need to force institutions to defend their legitimacy publicly, because legitimacy is fragile. Once cracked, it never fully returns. Even if regulators ultimately prevail legally, even if the banking pressure resumes, the damage is already done. People are asking questions they weren't supposed to ask. Who decides who is bankable? Based on what standard? With what oversight? And what recourse exists when power is abused quietly instead of loudly? Those questions don't disappear after a ruling. They linger, they become hearings, they become reform proposals, they become political platforms, and that's why this moment matters more than any single election. If the court reins in regulators, it signals a return to due process and formal authority. If it doesn't, it signals the normalization of economic exclusion as a tool of governance. Neither outcome is small, and neither can be undone. So here's the bottom line. Stripped of emotion, stripped of loyalty, stripped of Trump himself, a line has been tested between regulation and punishment, between risk management and retaliation, between independence and unaccountable power. Whatever happens next will define how far institutions can go without ever charging a crime. And once that boundary is redrawn, it applies to everyone, not just presidents, not just billionaires, not just political figures, everyone. This story won't end with a verdict. It will end with a precedent. And that precedent will shape who gets to participate in economic life and who can be quietly erased from it. That's what's really at stake. And that's why this isn't over, not even close.